and then you get that next leg of strengthening, and then that weakening, that's where you'll see this reprieve in commodities. In fact, if you just look at gold sentiment today, which you can kind of look at it as sentiment on the dollar, as a proxy for sentiment on the dollar, it's pretty extended to a weak weak view on, or a negative view on gold. So, from that perspective, we can see the dollar weaken here going into the first quarter. It's also a seasonally, tends to be a seasonally strong quarter for commodities anyway. EM could benefit there, and then as obviously the different dynamics between just Japan, US, China, and Europe, you could definitely see the dollar continue its strengthening path. And then in emerging markets, essentially what we're trying to do, given the strength in the dollars, we basically are just looking at which economies we think have shown this adjustment. So just look at external accounts, trade accounts, current accounts, and looking one by one to see who's adjusted most, their external positions, and really that's where we try and guide our positioning. And even there we continue to find some interesting opportunities. And the same thing with oil. People love to think of oil going down as immediately negative for emerging markets and frontier markets, but that's not necessarily the case, because I forgot the number now, it's like 1 billion people that benefit from higher oil, there's 6 billion that benefit from lower oil. And for every gain that you see or for every loss that you see in Saudi Arabia, UAE, and other countries across the Middle East, you have Pakistan, Bangladesh, India, even Mexico that benefit from lower oil, lower inflation, their ability to ease monetary policy. So it really leaves still a great environment for finding good opportunities. Even with this kind of middle move that you're going to see. And lastly, historically, emerging markets tend to be late-stage cyclicals. When U.S. rates start to go up, you typically saw emerging markets go up, and they were late-stage cyclicals similar to commodities, similar to energy. And that may be what we get once again, right? That's telling you that the U.S. economy is strengthening. Maybe we're seeing more strength in the global economy as a result into next year, now that we've got enough easing coming through Japan and Europe. And that's not a bad environment to be looking at names that are very cheap with currencies that are extraordinarily cheap.
Luis, you mentioned, and Daryl, you did too, commodities and energy and oil, and I want to get Peter's take on this, just in terms of, I think outside of the Fed rates, everybody always wants to know where oil is going and what oil is going to do. Obviously, we can't predict the price of oil, but Peter, I want to get your take on, looking at where energy is, where oil is. What do you?
The real price of oil, you can see that it's at the lower end of the range that it's had over the past 4 decades. So, if you talk about a yield curve in the U.S., it's going to start to flatten out, where the short rates maybe go up a bit. The long end doesn't move so much. What that leaves U.S. investors with is still a yield-starved environment, and that's true really globally. So if you're a U.S. investor, you're going to hunt for yield. Well, if the idea of the dollar continues to be strong, well, that's not going to help you hunting for yield in developed markets. Emerging markets, there's a lot of play there. You can look for yield in emerging markets, and you can find it. And as I said, in my introductory comment, I worked in emerging markets for a very long time, so I've looked at emerging markets looking for yield and ended up finding yield today in our backyard, which perversely it's in oil. And the way it works is that if you have an appetite to buy a producing oil asset, well, the price you pay in the market, the going rate is a PV10 on the future production of that wellbore. Well, PV10, if you hedge it out, put a little bit of leverage, which leverage you can do LIBOR plus 275 to 350, you end up having a cash flowing asset with high yield that's going to hold its value relative to the oil price. So if you have an environment like that, you can have yield that is in dollars, that's in an asset that you can have title to, you can borrow against, and you can lever, or rather you can hedge, and then you get participation in the upside move in the oil price. So looking all around the world for yield, it turns out that the sell-off in the oil price actually is kind of refocused, where if you want to find yield, that's where you find it in buying oil assets today, right here in the U.S.
Are there specific assets that you're looking at?
Well, The best are the unconventional shale oil. So if you look at gas, natural gas, there's a lot of capacity that can come out as infrastructure is built out. With oil, that's simply not the case. Natural gas is a regional commodity, oil is a global commodity. So if you look at the price of oil is going to be dictated not by shale, which is something the Saudis have talked about, but the reality is it's the marginal producer that's going to set the price. So you end up where shale, the break even on producing shale oil keeps declining. And there's two reasons for that. It's driven by the productivity of a well is increasing as kind of the knowledge base of how to drill an unconventional horizontal well is increasing. So you see kind of 20 to 25% increases in well productivity over the past 5 years, year in, year out. And then you have a cost decline that's come from the service providers being under pressure. So we look at oil as opposed to natural gas. You have unconventional. Once you get through the first part of the decline curve, which is extraordinarily steep, you get a decline curve that's more stable than conventional. So you end up looking at the best plays would be Eagle Ford and the Permian. You can look at really Eagle Ford and Permian are the best two places to look for producing oil in the country.
Do any of the other panelists have any comments on petroleum or oil?
I have some opinions on oil. I think the price of oil is going much lower, and somewhere into the low 30s. Can everybody hear me?
Yeah.
Okay, all right. But if you take a trip to Texas and you start talking about buying some of these assets that Peter was talking about at $30, they're going to laugh at you. You just can't buy it at those levels. So I believe right now a lot of the repricing has they got it at somewhere around $50 a barrel. Is that fair to say? Or?
Well, we model everything out to show a return on today's strip. So we use today's prices, and the wellbore has to produce something about a 25 IRR for us to buy it.
And are the companies now, are they selling assets?
So there's two reasons you're going to sell an asset. The E&P, the way the oil industry works, upstream, you're getting paid to develop, meaning you're paid to drill. And at some point, you have to get rid of your existing production because you need to recycle your capital, put it back in the ground. So there's natural selling regardless of anything else that would otherwise be going on. There's natural selling. And if you think about the environment in the US, you've had oil production double over the past 5 years. That means that you've got a lot more production, a lot more natural sellers coming into the market. If you add to that the distressed sellers, so think about all the companies that are violating their debt covenants because their hedges are rolling off and they levered when oil was at $100. So there are distressed assets on top of that that are for sale. So the question really is, can you buy, are the sellers there? And the answer is yes. And for producing assets, it's easy. The price is PV10, just like if you're in real estate, there tends to be a cap rate applied to a certain market. Well, I can't tell you why it happens to be PV10 is what everyone talks about. Maybe PV9 is where you can transact. Where it gets tricky is when you buy a well, right next to it are locations that are also drillable, that you know the geology, and you can build a type curve. That's where, as you get a distressed seller in a lot of assets, you can pick those up incredibly cheaply. If you're private equity money, that's what your focus is on. If you're family office, if you're looking for yield, your focus is on buying the production itself.
So there's, I guess, a lot of companies right now that were overvalued that now are starting to show some value. And, from an activism standpoint, I'm known in certain circles as a friendly activist investor. But we haven't found too many people really willing to have serious conversations at the price levels where they're at right now today. And this is one of the areas that our firm has been focusing on is, finding assets like Energy 21, EXXI, for instance. The CEO is got the highest compensation of any CEO in the E&P space as a percentage of his as a percentage of the market cap of the actual company. So we feel that there's some opportunity in an activist role in the oil patch. It's just not as easy as other sectors, like if you were playing in the sector, for instance. And you know, it's just that's pretty much the point that I was trying to make earlier. I guess they're starting to change their tune as they violated the debt covenants, and they're you know, they're getting cash strapped on some of the you know, the more leveraged plays. But the higher quality names, Anadarko, Apache, I don't know if anybody has seen that in the last couple of weeks, but it was a deal that you know, wasn't successful. So they're trying to possibly lure some of the bigger you know, oil conglomerates in who have $500 billion of cash sitting on the sidelines looking for some of these energy assets.
So Michael, you kind of hit on some of the things that you're looking at, more specifically petroleum based, but you know, just looking at the macro trends that you're seeing right now, what is getting you excited in terms of opportunities, and what is kind of scaring you and keeping you up at night?
I guess the biggest area of concern for me is driven through supply. There's just a tremendous amount of crude oil, and there's actually a concern, a lack of storage for it, which this is unprecedented. A lot of the participants from the commercial side of things have been ignoring this trend towards you know, running out of storage, for instance. And I just feel like it's one of these things that one day we wake up and the market just decides all of a sudden to focus on it, you know. And so you got a U.S. storage. The opposite side of that is CapEx has been being cut for the last 18 months, and a lot of these E&P names haven't been reinvesting in new exploration and production. They've just been finishing up the wells that they already started, the exploration they already started. So, you know, we should start to see production in the U.S., you know, pull back in 2016 and, you know, especially 2017. But I think that the major macroeconomic theme is you have supportive measures in the U.S., and then you have 13 OPEC countries that are about to meet in, I think, 3 days from now. And these actual, you know, 13 countries, their budgets have been destroyed. They have to keep people in their countries happy, which is not a very easy thing to do. And there's just, if you look historically, trying to get 13 people with economic interests to agree to a quota and meet their own personal quotas for their country, it's kind of like a joke. So no matter what I believe happens on, you know, on the 4th, I believe they're all going to break. They're going to break their quotas, and they're going to produce more oil, and there's going to be more supply on an international level, which, you know, the world crude market isn't really run through, you know, WTI, West Texas Intermediate. It's more Brent based. Brent drives the price, so you're going to have downward pricing from, you know, from the world oil market, and supportive in the U.S. So that's one of the themes that I see playing out right now, and that spread between the two, WTI and Brent, has been a lot tighter than it's been in the last 10 years or so.
And also the same question now to the rest of our panelists as well, starting with Daryl. Just really quickly, kind of, you know, globally, what are the opportunities you're seeing, and you know, what's kind of keeping you up at night?
Yeah, again, so I think where we're non-consensus is our view of U.S. growth probably going to be worse than people expect in 2016, and global growth, same thing, revisions are going to continue to go lower. What keeps me up at night, quite honestly, is the Fed. You know, tightening at the end of the cycle is asinine at the best of times, and you know, again, we're almost 80 months into a cycle. This is one of the longest expansions in history, and it just makes no sense to us. What we like is kind of boring. We like the US dollar, we like long-term treasuries. What we don't like is oil. Oil, I think the bear case is pretty simple. China is the marginal purchaser. China's clearly slowing. We don't know how quickly China's slowing, but the next 3 or 5 years of China are going to be slower growth. Supply, well, CapEx is down and the marginal supply in the US. Supply is still very high globally. And then, the last thing on oil is, again, just, the fact that the US dollar is going to be strong, that'll be bad for oil. So, we kind of like the boring assets heading into 2016, US dollar, treasuries. We don't like oil. We're negative on high yield. And, the other thing I'd just say, in terms of stock-specific ideas, one of our top short ideas is, again, we're sort of taking the other side of chasing yield in the oil patch. We've been consistently short the MLP sector, and we still think there are good short opportunities in the MLP sector. Kinder Morgan is one of our top short ideas, and we think these are basically compensation schemes created by Wall Street. They're assets that are declining by and large. They're under invested, and they trade at multiples that just make no sense based on what the actual assets are. So that's kind of our summary heading into next year.
Okay.
What keeps me up at night other than my daughter in college, but she just started. But it's really EM debt. We as humans like to fight the last battle that we may have won or lost, and usually we're fighting the one that we lost. And we a lot focus on EM currencies, how that impacts sovereign debt, and it seems that for the most part, a lot of countries have taken care of the sovereign debt issues, have very high reserve levels, and again, just speaking generally. But really where we see a little bit of a fault line is in the EM corporate debt space. And so really it's what kind of an impact does further dollar strength have on the EM corporate debt space. Obviously that's going to be an area, and is already beginning, you can see it in Brazil, just an area of great opportunity for investors that are focused on, for whom that's their mandate. But then on the opportunity side, it's really, look, there's a lot of themes that we're looking at, and just to give you an idea of just one, we can talk more afterward, but it's, for instance, EM travel. The great thing about looking at emerging and frontier markets is we don't have to invent the wheel. We just we don't have to reinvent the wheel, excuse me. We just have to reapply it. For example, it's just a story of demographics and GDP per capita. When a certain country gets to a GDP capita at a specific level, for instance, in automobiles, it's about $3,800 to $4,000 per capita. That's the point where people start buying autos. And tourism has its own levels. And what we're seeing is just an absolute boom in tourism globally from emerging markets. Thailand has seen a doubling of Chinese tourists, and we're talking 10 million tourists. It's not from 100,000 to 200,000. In Dubai, now they're expecting 20 million visitors by the year 2020. That's the same as Japan, who is expecting the same target, 20 million by 2020, that they actually expect to get to sooner than that. One of the companies that we invest in is Emaar Malls in Dubai, largest mall in the world. They get 80 million people to visit that mall a year. 80 million. I mean, that's more than Disney. That's more. I forgot how we calculated. It was more than the Vatican, the Wailing Wall, and a couple other religious sites all put together globally. And so that takes us to Saudi Arabia. We invest in a company that's in religious tourism. UAE via Emaar Malls. To Korea and a duty-free company, Minor International. Panama in Copa Airlines that many of you are probably familiar with. So it's really just kind of looking at the world and seeing where demographics, where economic opportunities come, and regardless of the economic backdrop, there is a growth that's happening and there's an opportunity set that's growing. You just have to have a wide enough universe to look at to really be able to sift through and find them.
I think at a very high level, we are still equities over bonds. And so I think it's no surprise to anyone in the room that even though we actually do see much more muted returns across most equity markets, they still actually trump very negligible returns in bonds and cash. That being said, we are big proponents of being highly selective, not just by geography, sector, but also by factor. So if we think about geography, we're actually underweight U.S. equities. We actually prefer European and Japanese equities. This is somewhat of a consensus trade, but we are still hedged European exposure and we are unhedged Japanese exposure, thinking that the yen has run its course, and the euro, of course, still may have room to depreciate versus the dollar, especially with the ECB and Draghi set up to potentially reduce the deposit rate this week and announce an extension of QE by 6 months past September of next year, all the while with the Fed preparing to raise rates in a couple of weeks. So hedged European exposure, unhedged Japanese. We actually like emerging markets selectively as well. We actually think they're winners and losers. It's a good news, bad news game in terms of how commodities and the US dollar impacts these markets. And so we are big buyers of markets where reforms are in play, companies that are making great progress on structural reforms, building their current account surpluses, where they have limited foreign exchange reserves, where they have limited foreign currency denominated debt. And again, we think that emerging markets that are importers of commodities are very big winners. And this, there is a big concentration of these markets in emerging Asia. So we like emerging Asia very much. On the equity side, when it comes to sectors, we like pro-growth cyclical still. We like technology, we like the banks. Of course, financials tend to do better when interest rates rise and loan growth improves and net interest margins expand. We like healthcare, technology. If we think about fixed income, we would avoid the bond proxies, which is kind of relational to equities. A lot of investors have supplemented yield by investing in bond proxy equities like consumer staples and utilities and REITs, and we actually think that these stand in the bullseye of a potential Fed rate hike, especially since valuations are stretched in these sectors currently. We actually think that quality is going to matter very much going forward in investment grade. So we think that fundamentals are going to come home to roost much more than they have in the past in terms of investment grade. We actually do see some, I think you mentioned being negative on high yield, and we actually do see some opportunity in high yield. Credit spreads have, of course, widened quite a lot, so the term premium is there. I think the big question is, what are these spreads pricing in? Is it actually, implied default rates increasing in a deterioration of these credits, or, is the high yield, are we painting high yield with a broad brush because of deterioration in resource and in credit specifically? We think that a lot of the yield spread widening has been driven by energy and resource credits, and so if you can be selective in high yield, you might actually get paid there. We actually like hard currency, emerging market debt, as well as long-dated munis. So again, we think you can get very selective. Active managers are going to be paid in an environment where volatility and the dispersion of returns is increasing, which we actually believe is an environment that we're stepping into. As we all know, active management, it's been a struggle the last several years to outperform your benchmarks, to outperform ETFs and benchmarked and index funds. We actually think that that active management is going to and should be a much bigger part of portfolios going forward, as alpha is likely going to drive more returns than beta.
Okay.
Yeah, there's a big difference between portfolio securities and actually buying the underlying asset. So I agree, just to get back to some comments about the oil sector, that if you look, for example, at publicly traded companies, you'll see that the number is 83% of their cash flow is going to debt service, which is unsustainable, clearly. So MLPs and then publicly traded securities that are long these assets are struggling with their balance sheets. If you step in and buy the assets from them, that helps them satisfy their creditors and puts you in a position with a clean slate to take advantage of the price environment that we're in today. To touch on the price environment a little bit, so what I see is spare capacity has been typically an incredibly good leading indicator of where oil prices are going to go. With the explosion of shale production, you move spare capacity from being really Saudi Arabia to being shared between the Saudis and, say, the US shale producers. But where you stand now, you've got between the Saudis and the Russians and their political goals being very much at odds. That what's really going on is in the Saudi decision-making process, it's down to one guy, he's 30 years old, it's never been seen before, done before, where one person was calling all the shots. So you've even seen in the news a Saudi prince calling for a regime change. So there's a lot going on with the Saudis, there's a lot going on in Russia. If either or both of them make any move whatsoever to cut, oil prices will move higher. The shale production is not going to drive where oil prices ultimately go. So it's more these larger events are what will drive where the price is going to go. Demand will clip along, regardless if China could slow. We all expect it should slow, and it's in all the numbers. But demand will continue to move up 1 million to 1.5 million barrels a day. And so if you look at the shut-in projects which are being canceled, all the offshore drilling is gone, a lot of the stuff in West Africa, if you're looking in Siberia, forget it. So and then Canada's having trouble. So if you start to look a few years down the road, that's where you're going to start to have problems, because these projects are long dated and they're not going to be coming on. They're being canceled outright. So then if all we're going to do is look at shale to solve the problem, it can't solve the problem. So the medium-term view on oil, to me, speaks more higher than lower. Short-term, any number of things can move the price back to the mid-30s, and maybe it could even sit there. But I think the bigger prognosis would be upward. But back to, I understand from the comments that a lot of you invest in portfolio stocks, and I would agree with the comments that there are a lot of troubled companies out there, and if you were looking at